All right, let's dive into a puzzle that trips up a ton of investors. We're going to talk about two funds, the classic Nifty 50 and its cousin, the Nifty 50 Equal Weight. The weird thing is, they hold the exact same companies, but the results, well, they tell two totally different stories. And this is the million-dollar question, right? You've got two funds, both tracking India's top 50 companies. You'd think their performance would be pretty much identical, but it's not. Not even close. So what's the deal? Why the huge difference? You know, the entire secret, the key that unlocks this whole puzzle, it all boils down to just one thing: weighting. It's not about which companies are in the fund, it's about how much of each company the fund holds. That's everything. Okay, so first up is the standard Nifty 50. It uses something called market cap weighting. It's actually pretty simple. The bigger the company's market value, the bigger its slice of the pie. Think of it like a pyramid. You've got a few massive giants at the top, and their performance pretty much dictates how the whole fund does. And here's what that pyramid structure looks like in real life. You can see the standard Nifty 50 is super concentrated. Financial services, wow, it makes up more than a third of the entire index. That means the fund's success really depends on how just a couple of key sectors are doing. Now, for the alternative, the equal weight fund, it completely flips the script. Forget that pyramid. This is a level playing field. Every single company, from the biggest giant to the smallest of the 50, gets the exact same slice, 2%. And look at the difference that makes. Financial services is still a big piece of the pie, of course, but its dominance is way down. And that gives other important sectors like consumer goods and pharma a much bigger voice. It just creates a portfolio that's way more balanced and diversified. Let's just put some hard numbers on this, because the difference is pretty shocking. In your standard Nifty 50, the top 10 stocks make up a whopping 60% of the entire fund. In the equal weight fund, just 20%. And to keep that perfect balance, the equal weight fund has to rebalance every quarter, which forces it to sell high and buy low. The standard fund? It only tweaks things twice a year. Okay, so we get it. They're built differently. But that all leads to the one question we all really care about. Which one actually performs better? Let's get into the numbers. So, what does all this structural difference actually mean for your money? Well, get this. Over a 5-year stretch, the equal weight strategy didn't just do a little better. It outperformed by an average of 4.5% every single year. I mean, in the world of investing, a gap that big is an absolute game changer. And you know, this wasn't some one-time fluke. Just look at the annualized returns here. This story is incredibly consistent. Whether you're looking at a 3-year, 5-year, or 7-year period, the equal weight index has pretty consistently delivered better returns than the good old Nifty 50. So what's the secret sauce behind this outperformance? Well, it's pretty simple, really. Equal weight funds just shine when the whole market is doing well. By giving a voice to every company, not just the mega caps, they're able to catch that growth from all corners of the economy, not just from the very top. Okay, so higher returns. The case seems closed, right? Equal weight is the obvious winner. But hold on, performance is never the whole story. We've got to look at the hidden stuff, the risk, and more importantly, the cost. And you know, this is the exact thought that trips up so many people. You see those higher return numbers and you think, well, that's it. It's an open and shut case. But with investing, the obvious choice, it isn't always the right one. So not so fast. Before we jump to any conclusions, we have to pop the hood and look at two things that can seriously make or break your results in the long run: how bumpy the ride is going to be, and exactly how much you're paying for it. Now this is a genuine surprise. You'd probably expect the strategy with higher returns to be the riskier one, but the data actually shows the complete opposite. Because it's more diversified across the board, the equal weight index has historically been less volatile. It's actually been a smoother ride. But there's always a catch, isn't there? Here it is. All that quarterly rebalancing we talked about, that's not free. That extra activity comes with a higher price tag. The average expense ratio for an equal weight fund is about double what you'd pay for a standard Nifty 50 fund. You're basically paying a premium for that disciplined strategy. And please, don't underestimate what a tiny percentage can do over many years. Let's say you invest 10 lakh rupees. Over 2 decades, that small difference in fees means you'd pay almost 3 lakh rupees more for the equal weight strategy. That is a huge chunk of your money that's just gone before you ever even see it. Okay, so let's weigh this out. We've got higher potential returns and lower volatility on one side, but we've got significantly higher costs on the other. This brings us to the final verdict. How do you figure out which one of these funds is right for you?
The truth is, there's no single right answer here. It really depends on your own personal investor profile. If you're a growth investor and you're all about maximizing returns and you're cool with the higher fees, then yeah, the equal weight fund could be a fantastic choice. But if you're a more conservative investor who wants to keep costs as low as possible, then the classic Nifty 50 is a perfect fit. And hey, if you're a balanced investor, you can have the best of both worlds. Just split your money 50-50 between the two.
So let's just boil this all down one last time. The equal weight fund offers the chance for higher returns and a smoother ride. The standard Nifty 50 is the absolute king of low costs and simplicity. At the end of the day, it's all about one trade-off. Are you willing to pay those higher fees for the potential to outperform? There's no right answer. There's only the right answer for you.
And that's really the bottom line. You now get the engine that drives both of these powerful strategies. So the question isn't which fund is better anymore. The real question is about you. Which one of these strategies lines up with your goals, and what does your choice say about the kind of investor you really are?